There's something happening in the gold market right now that most people are completely missing. And I'm not talking about the price hitting new all-time highs. I'm talking about a pattern that's been quietly forming in the charts for the past 18 months. A pattern that's only appeared twice before in the last 50 years. And both times, gold didn't just rally, it exploded. The first time this pattern showed up was in late 1978. Gold was trading around $200 an ounce. Most investors thought it was overvalued. The mainstream financial press was calling it a bubble. But this pattern was forming in the background. And over the next 16 months, gold went from $200 to $850. That's a 325% gain. The second time was in 2007. Gold was around $650. Again, the talking heads said it had run too far. But the pattern was there. And by 2011, gold hit $1,900. Another 192% move. Now here's what makes this absolutely critical. This pattern doesn't just predict that gold will go up. It predicts the magnitude of the move. And based on what I'm seeing right now, with gold currently around $2,650, this pattern is suggesting a move to somewhere between $5,800 and $6,200 per ounce. I know that sounds insane, but let me show you exactly what I'm looking at. The pattern I'm talking about is what technical analysts call a multi-year accumulation base with expanding institutional participation. That's a mouthful, but here's what it actually means. For the past 18 months, gold has been trading in a relatively tight range between $1,900 and $2,100. Most retail investors got bored. Trading volume from small speculators dropped off. The financial media stopped covering it. But while everyone was looking away, something fascinating was happening underneath the surface. Central banks were buying at a pace we've never seen before. In 2022, central banks purchased 1,136 tons of gold. That was a record. Then in 2023, they bought 1,037 tons. Another near record. But here's the kicker. In just the first 9 months of 2024, they've already purchased 694 tons. They're on pace to break the record again. And it's not just the usual suspects. Yes, China and Russia are buying, but so are Poland, Singapore, the Czech Republic, and even countries like Libya and Iraq that have been sitting on the sidelines for decades. Why does this matter? Because central banks don't trade. They accumulate. When they're buying at this pace, they're not looking to flip gold for a quick profit next quarter. They're repositioning their reserves for what they see coming over the next decade. And what they see coming is a fundamental restructuring of the global monetary system. Let me give you a specific example of what I mean. In September 2024, the People's Bank of China made a quiet announcement that barely got any coverage in Western media. They revealed that their official gold reserves had increased to 2,264 tons. But here's what's interesting. Independent analysts who track Chinese gold imports and domestic production estimate that China actually holds somewhere between 4,000 and 5,000 tons. That's a massive discrepancy. Why would China underreport their gold holdings? Because they're still accumulating. If they announced their true holdings, it would drive the price up before they're finished buying. This is the same strategy they used with their treasury holdings for years. Buy quietly, report slowly, and only reveal the full position once you're done accumulating. And right now, they're not done. But it's not just central banks. Look at what's happening with the big institutional players. In the second quarter of 2024, gold ETFs saw their first significant inflows in over 2 years. $1.2 billion flowed into gold ETFs in just 3 months. That might not sound like much compared to the trillions sloshing around in equity markets. But remember, gold had been seeing consistent outflows for nearly 18 months. This reversal is significant. And then there's the COMEX data. This is where it gets really interesting. The Commitment of Traders report, which shows positioning by different types of traders, has been showing something unusual. Commercial traders, the big banks and institutions that actually deal in physical gold, have been reducing their short positions to levels we haven't seen since 2019. Meanwhile, their long positions have been quietly growing. Now, commercial traders are typically on the opposite side of speculators. When retail traders are bullish and buying, commercials are usually selling to them. But right now, commercials are positioned bullishly. That's rare. And historically, When commercials are net long and retail is net short or neutral, that's been one of the most reliable buy signals in the gold market. So we've got central banks buying at record pace. We've got institutional money starting to flow back in. We've got commercial traders positioned for a rally. That's the accumulation base I'm talking about. But here's what makes this pattern so powerful. It's not just about who's buying. It's about why they're buying. Let's talk about what's actually driving this. And I'm not talking about the usual inflation narrative, although that's certainly part of it. I'm talking about something much bigger. The global monetary system is fragmenting, and gold is being repositioned as the neutral reserve asset in a multipolar world. Think about what's happened over the past 3 years. The United States froze Russia's dollar reserves after the invasion of Ukraine. That was $300 billion in assets that Russia thought were safe, suddenly inaccessible. Now, whether you agree with that decision or not, it sent a message to every other country in the world. Your dollar reserves aren't really yours. They're only yours as long as Washington says they are. That's a problem if you're China and you're sitting on over $3 trillion in dollar-denominated assets. Or if you're Saudi Arabia and you've been recycling your oil revenues into treasuries for 50 years. Or if you're any country that might find itself on the wrong side of U.S. foreign policy at some point. Suddenly, you need an alternative. And the only asset that's truly neutral, that can't be frozen or sanctioned, that has no counterparty risk, is gold. This is why the BRICS nations have been talking about a gold-backed trade currency. Now, I don't think we're going to see a formal gold-backed BRICS currency anytime soon. The logistics are too complicated. But what we are seeing is a gradual shift towards settling trade in currencies other than the dollar, with gold serving as the balancing mechanism. Here's a concrete example. In 2023, China and Brazil agreed to settle their bilateral trade in yuan and reais, bypassing the dollar entirely. The volume isn't huge yet, but it's growing. And when there are imbalances, when Brazil has more yuan than it wants or China has more reais, they're settling those imbalances with gold. It's not official. It's not announced. But if you track the gold flows between these countries, you can see it happening. The same thing is happening with India and Russia. Russia is selling oil to India. India is paying in rupees. Russia doesn't want to hold massive amounts of rupees, so they're converting them to gold. Again, you can see this in the trade data if you know where to look. Russian gold exports to India have increased by over 400% in the past 2 years. This is the de-dollarization trade that everyone talks about, but few people actually understand. It's not that the dollar is going to collapse overnight. It's that the dollar's role as the sole global reserve currency is slowly eroding. And as that happens, gold's role as the ultimate reserve asset is expanding. Now, let me connect this back to the price pattern I mentioned at the beginning. In 1978, when this pattern first appeared, what was happening? The Bretton Woods system had just collapsed. Nixon had closed the gold window in 1971. The world was transitioning from a gold-backed dollar to a pure fiat system. There was massive uncertainty about what would replace the old order. And gold went from $200 to $850, as investors and central banks repositioned for the new reality. In 2007, when the pattern appeared again, what was happening? The subprime crisis was beginning. The global financial system was on the verge of collapse. Central banks were about to embark on the largest monetary experiment in history, printing trillions of dollars in quantitative easing. Again, massive uncertainty about the future of the monetary system. And gold went from $650 to $1,900. See the pattern? This formation doesn't just appear during normal bull markets. It appears during periods of monetary transition. And right now, we're in the early stages of the biggest monetary transition since Bretton Woods. The unipolar dollar system is giving way to a multipolar system, where multiple currencies and gold all play a role. And if history is any guide, gold is going to reprice significantly higher to reflect that new reality. Let me give you some numbers to put this in perspective. Right now, gold represents about 15% of global central bank reserves. That's up from around 10% a decade ago, but it's still relatively low by historical standards. In 1980, gold represented over 60% of central bank reserves. Now, I'm not saying we're going back to 60%, but what if we go to 25%? What if we just go to 30%? To get to 25% of reserves at current reserve levels, central banks would need to hold approximately 50,000 tons of gold. They currently hold about 36,000 tons. That means they need to buy another 14,000 tons. At current production levels of about 3,000 tons per year, and with mine production actually declining in many regions, that's nearly 5 years of total global production. And that's assuming no other demand. No jewelry demand, no industrial demand, no investment demand, just central banks. Obviously, that's not how it works. Central banks can't just buy all the gold. But here's what happens instead. As central banks try to accumulate, they push the price higher. As the price goes higher, it attracts investment demand. As investment demand increases, it pushes the price even higher. And you get a feedback loop. This is exactly what happened in 1978 to 1980 and again in 2007 to 2011. But there's another factor that makes this cycle potentially even more powerful than the previous two. The amount of paper gold versus physical gold has never been higher. The COMEX and LBMA trade hundreds of millions of ounces of gold every day. But the actual physical gold backing those trades is a tiny fraction of that. Most of it is just paper claims on gold, futures contracts, unallocated accounts, ETFs that may or may not have the gold they claim to have. This works fine in normal times. But what happens when everyone wants physical delivery at the same time? What happens when central banks start demanding physical instead of accepting paper claims? We've already seen hints of this. In March 2023, there was a brief squeeze in the London gold market where the spread between paper gold and physical gold blew out to levels we hadn't seen in years. It resolved quickly, but it was a warning sign. If we get a real physical squeeze, where demand for actual metal overwhelms the available supply, the price could gap up violently. I'm talking about moves of $200 or $300 in a single day. And once that happens, once the paper market breaks, there's no telling where the price could go. Because at that point, it's not about supply and demand in the traditional sense. It's about monetary trust. And when monetary trust breaks, gold becomes priceless. Now, I know some of you are thinking about your own financial situation right now. Maybe you're sitting on retirement accounts that are heavily weighted toward stocks and bonds. Maybe you're worried about inflation eating away at your purchasing power. Maybe you're concerned about the stability of the banking system after what we saw with Silicon Valley Bank and the regional bank crisis. Quick aside here. If you've got $100,000 or more in retirement savings, I put together a comprehensive guide on how gold IRAs actually work. It's completely free, and it's in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties, what the rules are, what the costs look like, all of that. Worth checking out if this is relevant to your situation. No pressure, but it's there if you want it. Anyway, back to where this price is headed. Let me walk you through the math on how I'm getting to this $6,000 target. It's not just a random number pulled out of thin air. It's based on 3 different analytical approaches that all point to a similar range. First, there's the technical analysis. If you look at the long-term chart of gold going back to 1971, you can draw a logarithmic trend channel that captures the major bull and bear markets. Right now, gold is testing the middle of that channel. The top of the channel, based on the current trajectory, is around $5,800. That's the technical target if gold reaches the upper bound of its long-term trend. Second, there's the monetary analysis. If you look at the total amount of base money in the global financial system, the M0 money supply, and you divide it by the total amount of gold held by central banks, you get what's called the gold coverage ratio. Right now, that ratio suggests gold should be trading around $4,200 per ounce just to maintain the same coverage it had in 2011. But if you adjust for the additional money printing since then, and you assume central banks want to increase their coverage ratio back to historical norms, you get a number closer to $6,200. Third, there's the inflation-adjusted analysis. The all-time high for gold was $850 in January 1980. If you adjust that for inflation using the official CPI, you get about $3,200 in today's dollars. But if you use the pre-1990s CPI methodology, which many economists argue is more accurate, you get closer to $5,500. And if gold is going to serve as a monetary hedge in a world of persistent inflation, it needs to at least match its inflation-adjusted high. That gives you a range of $3,200 to $5,500, with the higher end being more likely given the current monetary environment. So, You've got technical analysis pointing to $5,800, monetary analysis pointing to $6,200, inflation-adjusted analysis pointing to $5,500. The average of those three is right around $5,800 to $6,000. That's where the target comes from. Now, I want to be clear about something. I'm not saying gold is going to $6,000 next month. This is not a short-term trade. The pattern I'm describing typically plays out over 2 to 4 years. We're probably in the early innings right now. But the setup is there. The fundamentals are there. The technical pattern is there. And if history is any guide, we're going to see a significant repricing of gold over the next few years. But here's what you need to understand about how this move is likely to unfold. It's not going to be a straight line up. There will be pullbacks. There will be periods where it feels like nothing is happening. There will be moments where the financial media declares the gold rally dead. That's all part of the pattern. In fact, those pullbacks are healthy. They shake out the weak hands and set up the next leg higher. The 1978 to 1980 rally had multiple 15 to 20% corrections along the way. The 2007 to 2011 rally had a brutal 30% correction in 2008 during the financial crisis. But in both cases, the overall trend remained intact, and patient investors who understood the bigger picture were rewarded. What's interesting about the current setup is that we haven't really had a significant correction yet. Gold has been grinding higher, but it's been relatively steady. No panic buying, no euphoria, no retail FOMO. That tells me we're still early. The real fireworks happen when retail investors finally wake up and start piling in, and that usually doesn't happen until gold breaks through a major psychological level and stays there. For this cycle, I think that level is $3,000. Once gold convincingly breaks $3,000 and holds above it for a few months, that's when you'll start seeing mainstream coverage. That's when your neighbor will start asking you about gold. That's when the financial advisors who have been ignoring gold for years will suddenly start recommending a 5% allocation. And that's when the real acceleration begins. But there's another catalyst that could speed up this timeline significantly, and that's a currency crisis. Right now, the dollar is still relatively strong. The dollar index is hovering around 105, which is elevated by historical standards. But that strength is masking some serious underlying problems. The U.S. is running a fiscal deficit of over $2 trillion per year. The national debt is approaching $36 trillion. Debt service costs are now over $1 trillion annually, which is more than we spend on defense. And there's no political will to address it. Both parties are committed to spending more, not less. At some point, the bond market is going to revolt. At some point, foreign buyers are going to demand higher yields to compensate for the risk. And when that happens, the Fed will face an impossible choice. They can either let yields rise, which would crash the economy and the stock market, or they can step in and buy bonds, which means printing more money and risking a currency crisis. Either way, gold wins. If yields rise and the economy crashes, gold wins as a safe haven. If the Fed prints and the dollar weakens, gold wins as an inflation hedge. It's a no-lose scenario for gold, and we're already seeing early signs of stress. In October 2024, the yield on the 10-year Treasury spiked to 4.9%, the highest level in over a year. The Fed had to make some carefully worded statements to calm the market, but the underlying pressure is still there, and it's building. Here's something else that's not getting enough attention. The petrodollar system is breaking down. For 50 years, oil has been priced in dollars. Countries that wanted to buy oil needed dollars. That created automatic demand for dollars in treasuries. But that's changing. Saudi Arabia is now accepting yuan for oil sales to China. Russia is selling oil in rubles and rupees. The UAE is settling oil trades in dirhams. The petrodollar isn't dead, but it's dying. And as it dies, one of the main sources of structural demand for dollars is disappearing. What replaces it? Gold. Not immediately, not officially, but gradually, gold becomes the settlement mechanism for international trade imbalances. And as that happens, the price has to rise to accommodate the increased monetary role. Let me paint you a picture of what I think the next 2 to 3 years look like. We're currently around $2,650. Over the next 6 to 9 months, I expect gold to grind higher, probably testing $2,900 to $3,000. There will be a pullback, maybe back to $2,600 or $2,700. The media will say the rally is over. But then, sometime in late 2025 or early 2026, something will happen. Maybe it's a banking crisis. Maybe it's a sovereign debt crisis in Europe. Maybe it's a geopolitical shock. Whatever it is, it will remind people why they own gold. And that's when gold breaks through $3,000 and doesn't look back. From there, I think we see a relatively steady climb to $3,500 by mid-2026. Another consolidation. And then the final leg, driven by retail FOMO and a potential currency crisis, takes us to $5,500 to $6,200 by late 2027 or early 2028. That's the roadmap. Obviously, the exact timing could be different. Markets don't follow scripts. But the pattern is clear. The fundamentals are clear. And the historical precedent is clear. Now, here's what you need to be thinking about. If gold goes to $6,000, what does that mean for everything else? It means silver probably goes to $150 or higher, because silver typically outperforms gold in the late stages of a precious metals bull market. It means mining stocks could see 300 to 500% gains because they're leveraged to the gold price. It means real assets in general, things like commodities and real estate, are going to outperform financial assets. But it also means something darker. It means the monetary system is under serious stress. It means inflation is probably persistent and elevated. It means the purchasing power of your cash and bonds is eroding. It means the social contract between governments and citizens is fraying. Because gold doesn't go to $6,000 in a healthy, stable world. It goes to $6,000 when people lose faith in the alternatives. So yes, there's an opportunity here. A massive opportunity. But it's an opportunity born out of crisis, and you need to understand that. This isn't about getting rich quick. This is about preserving wealth through a period of monetary transition. This is about making sure that when the dust settles, you're still standing. The hidden pattern in the gold charts is telling us that transition is coming. The accumulation by central banks is telling us that transition is coming. The breakdown of the petrodollar is telling us that transition is coming. The question isn't whether it's coming. The question is whether you're positioned for it. Because here's the thing about these major monetary transitions. They don't happen often. The last one was 50 years ago, and the people who understood what was happening, who positioned themselves correctly, they didn't just preserve their wealth, they multiplied it. They bought gold at $200 and sold it at $850. They bought real assets when everyone else was holding cash, and they came out the other side in a completely different financial position. This is that moment again. The pattern is forming, the pieces are in place, and the clock is ticking. The question is, what are you going to do about it?